to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. Good morning, AJ. How are you doing, sir?
I'm getting ready to hop on a plane. I'm getting ready to go back into the East Coast, but other than that, I'm doing well.
We got a lot still going on in the markets. A lot of volatility. Volatility is good for us premium sellers. Where
You
should
betcha.
where should we dig in today? I
Well,
guess the Fed hike, right? Because that
the
was the big.
Fed rate hike, and more importantly, like the Fed did exactly what everybody thought they would do, raise a quarter point. But it was kind of the speeches by Mr. Powell, Jerome Powell, the Fed chief, and the speeches by Janet Yellen throughout the week that kind of caused a little bit of worry in investors, caused a sell off in just the last couple of days. Um, they basically said, we will bail out banks. We maybe won't bail out banks. Your investments, when you put money into the bank, is safe. Maybe it's not safe. The Fed said maybe we'll raise rates. We're definitely not going to lower rates. Some people thought they might start lowering rates. The Jerome Powell said, I don't think we're going to lower rates. So investors are still left as uncertain as they have been.
And I guess it was a little surprising, right? Was in the market pricing in 50 basis points. We got a quarter.
At
Right.
one point before the banks started failing, you better believe it. The market was like, well, maybe, we've got to price in 50 basis points. But then as soon as Silicon Valley Bank and then Signet Bank, and now we've got Deutsche Bank, we got Credit Suisse. As soon as these banks started falling, these mid-sized banks, the Fed had to take some action and decided to pull back, but they didn't pull back all the way to zero. There was a contingent. In fact, we've got it up on the screen, or I'll put it up on the screen. We've got now there it is. We've got the anticipation for the May 3rd. So we're already, investors are always forward looking. We got what happened on Wednesday. Now they're thinking about the May 3rd Fed meeting. And on the May 3rd Fed meeting, they're looking at the rates staying flat. 91.7% of investors right now are looking at rates staying flat. There is a small amount, 8.3% of investors, that think there's going to be another quarter point rate hike. But for the most part, right now, investors think the Fed's going to stay solid, right?
And so we've got the Fed news paired with what's going on with the banks still, right? So it's starting to spread overseas, right? Because the Credit Suisse, I think, was purchased by UBS, and now this morning there's some news of Deutsche Bank and the collateralized debt the whatever those fancy commingled bonds,
Yes.
right, and insurance are starting to implode again, right?
You know what? Commingle is a good word. So, the Fed is not operating in a vacuum. The Fed is actually interfacing with a lot of the other central banks around the world, and they're kind of coordinating their rate hikes so that everybody is moving in unison when it comes to different countries. So, Deutsche Bank, of course, is not a U.S. bank. They're based in, I believe, Germany, right? But the scoop is that in their world, in our world, it was the whole bond discussion that was making the banks uneasy. In their world, it's these, credit securities, but it's kind of the same thing, right? With the interest rates going up, some of these banks did not prepare for that. And so they're kind of in trouble, right? And another word maybe we can throw in there is contagion, right? Contagion. So when one bank starts to fail, then other banks start to fail as well. And they're, one of the things that these different central banks is trying to do is to control the contagion.
And in addition to that, we talked about this on our last episode, is the speed at which deposits can leave a bank, right? Because everyone is now connected to, their mobile apps. They can quickly hit the transfer buttons. I imagine that it has some momentum in this equation
Mhm.
where, hey, I just saw in the news that my bank is
Mhm.
about to fail. Maybe I should go wire all my money out, right?
I mean, that's a key piece of the problem. And so what they do is, and most of us know about this, right? If you've got any sort of connection with your banks, you know that you can link your two bank accounts from two different banks together and very easily, like overnight, press a button on your mobile phone and by tomorrow that money is in the other bank account. And so people are, they remember or they're being reminded of what happened in 2008 and that, behind some of the bigger banks, they basically said there's a certain size of bank that is too big to fail, and we're not, as governments, going to let that happen. And so when you get news that your community bank or your mid-sized bank or your more kind of aggressive bank that maybe you put your money in because they were advertising bigger returns or benefits for your small business, when you get any sort of hint that that money might be in jeopardy, what do you do? I mean, I know what I would do. I'd go to my app and I'd press that button and I'd move that money to one of those banks that are too big to fail, like a JP Morgan Chase, right? Or a Fidelity. These are, the top banks that we know the government's behind, the government's scrutinizing, and the government is making sure, putting their whole thing behind it and saying those banks won't fail. And so that causes a huge amount of depositor money, like overnight at the speed of light, moving from these small banks to the big banks. And that's basically what happened to Silicon Valley Bank and to these other banks that are dropping like flies.
I know when I was seeing the news that personally I was kind of looking at my crypto. I was like, because crypto can move so quickly from one
Mhm.
wallet to another, I really
Mhm.
felt that if I needed to move something quickly, I had those tools, and that's kind of like a very modern perspective to
Absolutely.
to trust the crypto. And it's almost like, well, that's why we created it. It was
Mhm.
created so that you could transfer it and keep it and it wouldn't go under and things like that. So very interesting to see all of this evolve.
Yeah.
Um,
I
I'm
mean, the big scoop is, coming back to this interest rate hike on Wednesday, if you start to look at the economic data that was released this week, right? We had existing home sales that was released on Tuesday. You can see that up on my screen right now. Existing home sales actually ticked up. It went higher than we expected it to. And that kind of explains, like, people are trying to get in these, big purchases of new homes and stuff. They can't really, like, justify the expense on a brand new home, so they're going for the existing homes and they're trying to lock in these mortgages before rates go any higher. So we saw a larger than usual uptake in existing homes from January to February, but you'll also notice year over year, I mean, the rate has dropped, right? Um, People are not buying houses as fast as they were a couple years ago, but compared month to month, there's a real uptick. Like, there's an excitement of, we got to lock in these rates before they go any higher. But then you look at new homes. New homes were released on Thursday, and man, the prior number, we were expecting 600 or we reported that 670. It actually got revised down quite significantly, that only 633,000 homes were put together. So that's a big drop in numbers. And then this time around, we expected 645 and only 640 came in. And if trend continues, it's basically saying, hey, some of these inflationary control tactics are being seen in the housing sector. We can kind of deduce that. And then durable goods orders, these are horrible. These are hard goods that we won't replace very often, like laundry machines and couches and stuff. And you can see that that really has been affected. I mean, we saw the number of new orders last month. We went back and we revised that down even more significantly. They dropped by 5%. And then you look at, we were expecting a 1.5% gain in those type of orders this month, February, and instead they dropped by 1%. So these inflationary control tactics are starting to sink in, right? Those tactics that the Fed took last year, they're starting to, in every area, housing, goods, so it's having an effect.
Yeah, but even it's having an effect on these inflation numbers, but it's also tilting the scales that are that is the banking system, and we'll talk about this later in the show about how they operate and why they do so. But the speed at the rate hikes are having the opposite effect, where it's kind of making the system a little uneasy.
Yeah, let's come back. Let's talk about that.
Yeah. So, do we want to dig into because I have your chart here now,
Mhm.
and that's the bond purchases, right? So,
I think I'm gonna roll that into the whole discussion about, why is it when a whole bunch of people move their money from these mid-sized banks into the bigger banks, why these banks then fail? There's a little bit more, and I think that the whole thing about the bond buying will explain it. And this is like some stuff, we'll come back, but this is some stuff that wasn't publicized in the last week or two on the mainstream media, but you listeners of ours should know what's happening behind the scenes.
yeah, before we dig into that, let's jump and look at the S&P real quick. Let's just see
Yes.
where we are with all of this volatility taking place, because I'm surprised that the market's holding up as well as it is with all of this negative news coming out.
Well, and so if we zoom out, and I always like to zoom out and this is something I tell all my program participants, that sometimes when you're looking at like a 3-month or a 6-month chart, you're too close in and you can't see the bigger picture. The bigger picture is we're sideways channeling. We've been sideways channeling for about a year now. And, that's a good thing when so many drastic levers are being pulled by the central banks. It's good that we're not seeing sell-offs. Instead, for the last year, we've just been seeing this sideways movement. Now, if you're a buy and hold investor, maybe you're not so excited about that, or even a directional investor, an investor who knows how to short the markets and make money on the way down. This might be too choppy for you and you might be quite frustrated. If you're somebody who has your money in like a retirement account, a 401k, you could also be quite frustrated with this type of movement. And that's why, for instance, we're so excited here, because we know how to take a sideways channeling market, something that's choppy and ugly like this, and we know how to create an income stream off of that with expiring options. But if I zoom in to like a 3-month chart, another thing I have to just ring my own bell here. We have our algorithm based on retracements that predicts where support and resistance lines are, and I can't help but just ring my own bell about how close we are with this price action on our lines of support and resistance. It's built so much confidence in our program participants that we basically know where price is going to reverse and come up and down. We can make really comfortable decisions about these different levels that I've defined here, because look, it's like a textbook. We're seeing these reversals confirmed. And so I just have to say, if anybody has thoughts about coming and learning from us here at Trading Trainer and getting access to some of our algorithms and tools, you should pull the trigger, because I'm actually impressed that I'm so right.
And looking at the chart, it looks like we're heading down,
Mhm.
which would correlate with the negative news in the market. And
True.
so, I believe later in the show we'll go over some examples of how you can take advantage of
Oh,
a
absolutely.
potential fall in the market. It looks like you're pulling up the VIX there, and we're starting to leg back up.
Yeah. I always like to pull up the VIX on these shows, and the reason is because if you are aware of our strategies where we sell options against, either shorted stocks or some back month options, we sell those options in order to create an ongoing monthly or even weekly income. What you might understand is when you sell those options as the VIX is going up, you get more and more money for the same options you're selling. And so we like to look at the VIX because right now we're making, I was just showing the program participants yesterday evening, SIP, in our weekly workshop. I was saying, usually we would be making, 30 cents, 40 cents, 50 cents a share on some of these premium sellings. Right now it's like $1.10, $1.20. So it's more than double what we usually make. And that's because the VIX is rising.
Awesome. And that's one of the tools and strategies implemented in the Trading Trainer system. And so,
Yeah.
real quick, before we dig into more of the bank chatter, right? Because that's a big topic today. We want to go ahead and give everyone an opportunity to check out AJ's free daily workshop where he breaks down these strategies on how to use selling options as a way of generating income. And so we've just thrown the link into the chat. If you haven't checked it out, check it out. We're going to take a little break. We'll come back. Once again, this is a live show where AJ's got his pick of the week coming up. We've got some user questions, but if you watching at home have something that you want AJ to look over, feel free to throw it in the chat and we'll try and have some time to go over it on the show. Otherwise, we'll be back in a few seconds. Stay tuned.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. So banks. I believe, I've had a couple people ask me this week, well, a bank like Silicon Valley, which funds a lot of successful startups, they have a lot of capital. How does a company like that become insolvent in a matter of 3 or 4 days? Like, what are the mechanics? How does that even happen? And how are other banks going to fail because of the actions? How do you explain that to an everyday Joe?
Yeah, let's give it a try. So here's the scoop. These banks put their money into bonds. So what are bonds, right? When you buy a bond, say you spend $1,000 to buy a bond, and that bond guarantees you at the time that you buy it that you'll get $50 a month by owning that bond, right? So great. Banks take a lot of their depositors' money and they put it into these bonds, and they're getting this kind of income off of the bonds. Problem is when the Fed raises interest rates, because now all of a sudden you can buy a bond that's going to pay you $100 a month instead of $50 a month. And so you might say to yourself, well, then I would want to sell my bond that's only paying $50 a month in order to get the one that makes $100 a month. Problem is nobody's going to want to buy it because they can go and buy for the same amount of money a bond that's going to pay $100 a month. Now, the banks wouldn't normally care about this because they don't care really that they spent the money to, the $1,000. They're getting that cash flow. So if everything was normal, they wouldn't actually be concerned because they're still getting the same amount of cash flow. Their numbers should be working out. The problem is when what we talked about earlier happens. The contagion starts happening. We see a news headline that says maybe your bank is at risk. And so you and I go into our apps and we move our money from Silicon Valley Bank to JP Morgan Chase, one of those banks that's been deemed too big to fail. So now all of a sudden, all of this money is leaving Silicon Valley Bank, and Silicon Valley Bank has to figure out a way to come up with that money because they took all that money that depositors gave them and they invested them in these bonds. So now they have to sell some of these bonds in order to pay off the depositors and move that money over to JP Morgan. So they're selling these bonds and these bonds aren't worth what they paid for them anymore. And so all of a sudden, and that's why, see, when interest rates go up, the price of the bonds go down that have already been sold because they're not as good as the new bonds. So they had to sell bonds in order to keep their bank whole, right? They didn't have as many cash reserves on hand. Instead, they had all their money invested in bonds, thinking that the bond rate would never change, which was the big, mistake. And when the bond rate did change, they had to sell these bonds at a big loss. And so that's kind of what created that insolvency. And so that brings us back to this kind of hidden tool that the Fed uses. If you take a look here, we've been watching it here. Sip and I check in on this weekly. And last week we knew something was up when the Fed took a break. That's this little, let me zoom in a little bit. There was this little break that the Fed took from selling bonds. They've been wanting to sell these bonds back to the market. And indeed, selling the bonds, just like raising interest rates, does, makes those bond rates go up. So they're selling those bonds, making those bond rates go up, and they needed to control it. So you'll notice the Fed in their rhetoric said, we're really not going to stop the fight against inflation. And they even did the interest rate quarter-point rate hike, which after what they did last year with 4 3/4-point rate hikes in a row, a quarter-point rate hike is like nothing, right? But take a look at what didn't get published in the news. They went just in that last week, and instead of selling bonds, they bought, look at, I can't emphasize this enough about how the markets are manipulated. Let me go back to a year. Remember, they had been hoping to sell off these bonds. They want to get from where it was at like $9 trillion. They wanted to, by 2025, they said they want to get all the way down to $4.5 trillion. So they got as low as about, what is that, about $8.325 trillion. And in 1 week, they're back up to they're almost halfway back up to where they started. And by doing this, by changing gears and buying the bonds, they basically have made it so that those bond interest rates that are being affected by these midterm banks, they're going to stay steady for a while so that the midterm banks aren't going to lose so much money if they have to fulfill depositors' wishes of moving their money from one bank to another. So the Fed behind the scenes, this hasn't been published. Unless you delve into the data the way we do here at Trading Trainer, you wouldn't realize this, but the Fed is pulling levers in order to keep these banks solvent. So it's interesting to see, because you don't hear that on mainstream media, but you know that they're behind the scenes doing stuff.
And could these actions be part of the reason why the market hasn't fully taken a nosedive, right? Because
absolutely.
Okay.
And it's also going to benefit those people who are buying the houses, because by doing this, by buying this many bonds back after they spent months and months, I just can't keep emphasizing this, Sip. It took like so many months just to get to this level. And then within one day, they're back up, and so the scoop is that's going to also affect mortgage rates, because mortgage rates are based on bond rates as too. So this spring, I expect to see a whole bunch of housing activity based on just what happened in the last week, because mortgage rates are either going to plateau or they may even drop in the short term based on what is happening here with this lever that the Fed is pulling.
Yeah, and the housing market's definitely one of those major sectors that if it took a blow, it could spill over into a lot of other industries.
Trying to control the contagion.
I did have a question on the small banks, and that's isn't that what the stress tests are, right? When we have these like oversight entities, isn't it their job to basically say, hey, you have too much in bonds. If we increase rates, you're not going to be capitalized enough to isn't that part of the issue? Like, shouldn't we have known that they would be at risk?
And so back in 2018, our congressmen, the brilliant folks that we have elected to run our country, decided to roll back some of these stress tests. Not really roll back the stress tests, but more roll back which banks needed to comply. So that's why, and this just adds to the pain of it all. That's why people move their money from these smaller, more risky banks to the bigger banks, because those bigger banks still had to comply with the stress tests. So the smaller banks, for some reason in 2018, were allowed to CLEP out. And it's not a Republican or Democrat or conservative or liberal thing, because that rule in 2018 was backed by just a bipartisan across the board. They're like, we're being too stingy with the banks. Let's let some of these smaller banks not have to go through the stress test process.
And part of that is an opportunity in one of the names, Citigroup, which we discussed last week. As being one of the names that had the strict, had to adhere by these strict regiments, and essentially isn't at risk. And so we had an opportunity to use options to take advantage of one of the names there, Citi. So if you haven't seen it, I believe we did put the clip up on YouTube. So go ahead and check that out. Otherwise, we've got some new names, some new tickers, some new opportunities to go over. And so if anyone has one that they want us to cover, feel free to throw it in the chat. Otherwise, we'll just go straight into your pick of the week. And this is a name we've covered in the past, a name most people might be familiar with, and that's the fast food retail chain, Wendy's, ticker symbol WEN. Is this what we would consider a boring stock?
Oh, it's so boring. Not only is it boring, but this company is paying nicely to the investors that own the stock. That's called a dividend. And so companies have a choice when they make profits to do a few different things. And one of the things they can do is take some of that money that they make in profits and invest back into, in this case, more restaurants, more employees, more training for the employees to be better burger flippers, whatever you want to do. The other thing they can do is they can give dividends back to the investor. And so that's what one of the tactics Wendy's has done. And what that does for us, because we really love those sideways channeling stocks. When we have something that's in a sideways channel, we can create an income trade around that that's protected to the top and the bottom. And so as long as it's going sideways, we just keep collecting income from it. And so when a company gives the investors a dividend, the investors don't put as much pressure on the company to increase their stock price, right? In other words, make the stock price not go sideways, because they're getting paid a different way. They're getting a quarterly dividend check. So if you're making money on your investment in a quarterly dividend check, you don't really care as much as if the stock price is going up, where you're going to make money on buying and selling the stock. So that's a nice thing for Wendy's, because Wendy's basically gets investor money, and the money doesn't go because people sell the stock at a high or a low, because the investors are there for the long term. And that benefits us because we sell premium against these type of patterns and can create an income trade on it using options. The reason why I featured Wendy's this time around is because we're coming down at this tested level of support around $20.50. And so I really like that, because we had featured, like you said, Wendy's before when they were at the top. And so for those of you that set up the income trade where you put in a initial covering position at the top, now's the time to create your income trade. And that would be selling your near term at the money puts, buying some protective calls. And if you missed that opportunity that we featured when we were at the top, you could set up a initial covering position in the next couple of days, where we would be setting ourselves up to sell calls and buying protective puts in the not too distant future. So either one of those transactions would work. And I wanted to feature Wendy's because Wendy's is clearly setting up for us and making like the perfect entry for setting up our income trade for the long term. It's a great stock and it's a great trade.
Yeah, it's got a lot of those bonuses. It's got a nice dividend. It's got an it's a brand that can weather the banking financial crisis, things like that. And so my question on the Wendy's trade is, how much would you need to invest to put this trade on? What's kind of the minimum?
Well, okay, that's a great question. So, first of all, we need two things if we're going to do a premium trade. We need to have the pattern that we've been kind of emphasizing, that sideways pattern. But in addition, you need to have a healthy options chain. And what I mean by that is you have to have the different strike prices that have a pretty good size increment. So if we look at our April options, they're trading every dollar. So we can design the perfect trade zone that underlying symbol stays within that would generate income, because we can basically place our options at every dollar increment. So that's nice. We also look for healthy liquidity, meaning that there's actually people buying and selling these different options. And so we have that. We've got open interest. We've got smaller bid ask spreads around our options. So we have what we need there to make it possible. So then, to circle back to your question, what we would do is we would calculate what would be the worst case scenario in this trade. Maybe the worst case scenario would be if the stock drops to about this $20 zone. And we could calculate, if that were to happen, what sort of loss would we be, potentially opening ourselves up to. And so you can calculate that loss and then compare that to the amount of loss you'd want to open up your portfolio to. A lot of my folks only open up their portfolio to the potential for a 2% or less loss per position. And so you'd size your position accordingly. Just because this thing is so inexpensive, meaning it's around the $20 to $25 mark, I would imagine, just because of my experience, you could probably get away with doing some trades on this with as little as a $5,000 retirement account, maybe even as little as $4,000. If you have more than that, if you have a $10,000 or $20,000 account, you'd totally be able to set up a trade on this and then just start creating the incomes. I would probably target with this to create an income of about 6 to 8% of your investment every time it bottoms and tops. And we would hope that happens monthly. So whatever you invest, say for instance, that's $10,000, we would expect to make $600, $800 every month. And that could grow pretty quickly on a nice $10,000 investment.
Yeah, and I'm pretty sure that's what a lot of the members in the trading trainer community have been doing for quite some time,
Yes.
because when we go over these examples, it is a very drastic risk to reward ratio, in the sense that 2% is what you're maxing out on the loss side, but the potential of 6, 7, 10, 12. I know we've done examples where it's 18% return. So
Per
it's
month,
really
yeah.
it's really about having that depth of opportunity, and that's what's one of the benefits of being with Trading Trainer. Is we've
And
got
what's
a lot
nice, oh, sorry, go ahead.
there's a lot of smart people calling out these opportunities every week.
What's nice about this Wendy's trade as well, just because if we go back in time, you can see Wendy's has been in this pattern for, gosh, let's go back to 2 years. You can see it's been in that same sideways pattern for years now. What's nice about this is that the longer you keep your initial investment in the position and then just put on and put off these premium selling positions, the more it kind of exponentially gains. The first thing that happens usually after the first or second cycle is that your position no longer has any potential for loss. In other words, we've collected enough income in the first or second cycle from this position that it reduces our break-even price to where we are totally covered. In other words, it becomes a risk-free investment within the first or second cycle. And then the gains growing, exponentially. So the longer we hold these positions, it's almost counterintuitive because traders, they like to jump in and jump out of things, and they think that that's the way to make money. It turns out with these particular positions, the longer you do nothing, the more money you can make because the gains go exponentially. They compound on each other. So I want all of our viewers to really take a look at Wendy's.
Yeah, the longer you do nothing, the more money you make. Wow.
It's true.
If it's just that simple, right?
It's really true. It's really true. The effort that we put into these positions is opposite. The least effort that we put in results in the bigger gains. And those people who, and it's almost like sometimes when we have these people who join our program who are like wanting to be reformed traders, it's almost very difficult. I almost have to like handcuff their hands because I'm like, stop touching the positions. Let them do what you designed them to do. You'll make more money in the long term that way.
Yeah, I always like to think of it as like insurance, right? Insurance, they make the most money when nothing happens and they just sit around. And
that explains, I mean, your terminology right there is spot on, Sip, because that explains why we're making so much money right now. That VIX measurement that we look at, and I'll bring it up really quick. That VIX measurement is kind of a measurement of whether people are fearful or confident right now. And so as it goes up, it means that the fear is going up. And really, what does that mean? It means that people are buying these options as insurance. And they want that insurance because they're afraid. They're afraid that the market is unpredictable. So they're buying this insurance. And because so many people all of a sudden have an interest in having and owning this insurance against their positions, the price of the insurance is going up. So they're willing to pay more for the insurance right now because they're that afraid of what might happen. What we're doing is we're selling the insurance. So that's why we're making more money than we usually do, is because the buyers are like begging us for this thing. So I always tell people, I'm like, analyze where the market is and make sure you're on the correct side of the equation. If the people who want the insurance are paying top dollar for it, get in the business of selling insurance, right? And so that's really what we do.
All right. Well, let's see if there's a few opportunities for us to sell some more insurance with some of our user picks or user questions from this week. And we'll head down south first. And this is Linus from Huntsville, Alabama. He's interested in a staple, United States Steel, ticker symbol X.
Let's take a look.
Sounds like a boring name, which is good for us.
Again, they given a dividend. It's not the best dividend. I mean, it's like a nickel per share every 3 months on a stock that you would have to pay about right now $24, $25 for. So if you calculate that out, it maybe isn't paying that good, but it's probably paying better than a savings account. But listen, I can see right here we've got a level of support that's being tested at $24. It looks like we do have a level of resistance that we can possibly count on around maybe $29. And so this is a great time. And US Steel is one of those companies that's been around for forever. We don't have to worry about crazy news making the price go up or down. It looks like we're coming down for a double bottom here, but once we get our way going back up, it might be an ideal time, Linus, for you to buy some of this stock. Or if you don't want to buy the stock, the other alternative, and let's take a quick look. The other alternative is to buy a option that can do the same job as the stock, maybe at a cheaper price. So I'm going to look at the January 2024 option. I want to go pretty far out in time. And sure enough, there is some activity. The bid-ask spread is not so bad on some of these deep in the money options. So instead of paying $24.60, we could set ourselves up for paying maybe $16, $17, or if you want to be a little bit more secure, $19.73. Still a discount off a $24 price. It involves a little bit of leverage, but either one of those, loading up on the stock or loading up on that option, will set us up for then making a premium trade out of this, selling the premium in the future and being able to start creating that income trade that Sip and I have been talking about, that long-term place where you put your money, you do very little effort, you put on the trade zone expires, you put on the trade zone, very little effort. The less you do, the more you'll make on these premium selling positions. And I think you found a good one. United States Steel. I think that we're getting ready here in order to set up that initial covering position that'll allow us to make it into an income generating position. So good on you, Linus.
All right, Linus, thanks for bringing that one up. We'll go ahead and head up east to Boston, Massachusetts. And this is Amanda, interested in a name I'm not too familiar with, and that's Rapid7, ticker symbol RPD. Rapid7.
I don't know much about this company. From what I think, I read like a little synopsis. I think, aren't they in cybersecurity? I'm not sure. Let's take a look here. Okay, I'll tell you a couple of red flags, Amanda. Red flags are around something like this. This is a historically volatile bar. That's price action in a single day. And then in 2 days, you can see price action like this. This makes it a little bit difficult for us to trade because it's a little bit sporadic. I don't see that they're giving dividends back to their investors. So their investors are probably pushing on this company to have some real like asset gains in the price of their stock. So probably a little bit more volatile, maybe not our best income generating, like long-term income generating position, but maybe in the short term. In other words, I'm finding some sort of level of support here, maybe around $40. So maybe you want to buy some of this stock and then sell some premium once it gets a couple of dollars higher. And it may be a trade that gets exercised quite quickly, like in the first month or anything. But as soon as you sell that premium and buy that protection, what's nice about setting up the trade zones, and when I say set up a trade zone, I mean you're buying premium at one strike price, you're putting on you're selling premium at one strike price, you're buying protection at another strike price, which basically encapsulates the underlying symbol. And so long as it stays in there, you generate income. But if you go out, this position automatically adjusts. It takes care of you, and you don't have to be right there and miss the opportunity and perhaps have a losing trade. Instead, the position takes care of it for you. You don't have to be present. You could be doing other things and not have to worry. And that's another thing I like about selling premium is once you've got the trade zone on, there's no need to worry about what's happening to the stock price because the underlying symbol or the position that you're in gets self-adjusted if something unusual happens. So I think that's what I would do here. I would probably set up a trade. I'd still want to go in like legging into the two different positions, but I wouldn't necessarily count on this position being there for the long term. I would basically get in at the bottom and then set my trade zone up when it's a couple dollars higher and then allow the position to just marinate.
Yeah, so thank you, Amanda. The one interesting part is you name a ticker, and because there's so many ways to use options to trade, AJ will probably find a way that you could trade it, but we're always looking, and he's always looking for that perfect, that quintessential setup that is proven time and time again. But we do appreciate the tickers coming up because sometimes there are those opportunities, and this one might be a little bit more on the risky side, but hey, that's part of the game.
I don't know about risk. What I think it is, Sip, is not risk, but I think it's more effort. You can't be as lazy as I like to be. I like to put my money into things and then let it just pay me back and not put so much effort. I think this would require some effort.
I think most people would like the greater return with the least amount of effort. So let's see if we could find that on our next pick. And this one is Chris from Tacoma, Washington, interested in St. Joe, ticker symbol JOE.
Real estate company. Oh, okay. Um, I know about St. Joe because I've sold premium against St. Joe. Okay, here's again where you have to zoom out in order to not get too confused. Because if you stay focused on the inside, you might think to yourself that this is a trending. And in the medium duration, it is trending. But in the long duration, check it out. We're in this sideways channeling symbol. I see here they're giving a nice 10-cent dividend. Again, maybe not that significant on a $40 stock. They do have positive earnings. We like that too. We like the company because we like to be in a company that's not going to be, disappearing overnight. Probably being affected by all the stuff happening in the real estate world right now. Let's zoom in and see if we can create a trade out of it. And I think SIP's right. We can create a trade. I mean, with options, you have the ultimate flexibility. You can create a trade on any pattern you identify. The question is there someplace better, an underlying symbol that's better that'll create that ideal trade that SIP mentioned, which is least amount of effort, highest reward, least amount of risk, right? But with that said, maybe we're bottoming here around $39. And so we can do the same thing we were talking about on Rapid 7. We can and let's take a look at the option chain. Let's go out far. Maybe this December option. Let's see what we've got there. See, when options, this is another thing you guys might want to know about options. The options are created by you and me, right? These options are agreements by individual investors with other individual investors where we would agree to either buy or sell a stock to you at a certain price before or at a certain date. That's what these things are. But in order for us not to have a whole bunch of lawyers involved to write up these agreements, we use standardized agreements and standardized increments at what those prices are that we would agree to buy and sell at and what those expiration dates are so that we don't have to worry about creating all the custom agreements between each other. We're using standard boilerplate things that a whole bunch of folks at the Options Industry Council came up with. So the Options Industry Council, every once in a while, usually when another option expires, will say, okay, you guys can start buying and selling and creating these agreements for the December 15th expiration date. And so you look over here and you realize there's not that much activity. That basically means that the Option Industry Council just came out recently, probably at the end of when the March options expired about a week ago. So when the March options expired, the Option Industry Council came out on that next Monday and they're like, okay, you guys, it's fair game. We've got you covered with all the legalese. You can start buying, selling, and making agreements for the December 15th. So these options are fairly new. Not many people have been buying and selling them yet. So the bid ask is big. The open interest is small, not much liquidity. But let's see for an option that maybe has been around for a while, like the September. Not many people are trading the September option either. Let's check the June option. A little bit more activity. I'm looking at the open interest. Still, the bid-ask spread is pretty large. So now I'm kind of having my druthers. Remember, we needed the two components. We need a nice pattern. And I don't even know if we have a nice pattern. And we need the nice option chain. And it looks like people are not as interested in even being part of the option trades on St. Joe anymore. So I hate to say this, and every once in a while we get a candidate like this, I'd move on. I'd see if there's another ticker symbol that would be more open for us to make money against.
And what's the price there? It's like 30
It's
something.
$40. So even if you did try to construct a premium trade on it, you probably need a portfolio size that's maybe 50 grand in order to pull this one off. So I think we move on. We let St. Joe kind of form a pattern here. We get more investors involved. Maybe we revisit it in 3 or 4 months and see if it's worth focusing on then. But I'd move on, Tacoma.
Yeah, and maybe check out that Wendy's trade, because that would be like half the cost or investment of looking at this one. So
Chris from Tacoma, I'd pass.
All right, Chris, appreciate the insight. Looks like we're getting close to the end of the show.
Oh,
what I wanted to do real quick was to give everyone an opportunity to grab your trading stash, right? So AJ's got this great section on his website. It's the Trading Trainer web portal, where he's got all sorts of white papers, courses, trading tools. And so it's completely free. If you're looking for some more information, some more tools to help guide you as you learn this art of premium selling and options, this is a great place to start. So we've gone ahead and thrown the link to that in the chat. So hop on in there and check that out. Otherwise, AJ, March 24th, we're getting close to the end of Q1. What should we be doing as investors? Finding opportunities to sell premium, I would guess, right?
Absolutely. Now, like I said, with that VIX kind of inching higher, I mean, this is like, we couldn't ask for a better gift as premium sellers from the Fed to be so like a combination of the Fed and the Treasury Department, to have them like waffling on their statements and having them, be like, gosh, I can't think of a better word than impotent, right? That Jerome Powell speech on Wednesday was just like, you didn't say anything, man. And so that would take a normal investor, a buy and hold investor or a directional trader, and drive them absolutely crazy. But for us, being on the selling of this insurance policy equation, you guys should be looking for every possible place, like a Wendy's trade, or what was the other one? US Steel trade, to go ahead and set up these premium. Change your focus from buy and hold to let's be the person who's selling the insurance to these high bidders, right? Because that's what I think you should be spending the next week on, just combing through your watch list, finding candidates that are solid companies, paying their investors dividends, going sideways. Let's turn those into some income trades. That's what I think we would do. That's the right thing to do, I think, for the if not short, medium term duration, right?
Yeah, and remember, folks, it's as easy as pulling up your trading app. The ability to sell options has never been easier. So now's the time to get in. And with that, we've come to the end of the show. If you've enjoyed the broadcast, hit that like, hit that subscribe, hit that follow button.
Tell your friends.
Tell your friends, tell your family, tell your auntie, tell your hairdresser. The
car salesman,
the car guy. Yeah. If you have any questions, feel free to leave it in the comments or send us a DM. We'll get back to you as soon as we can. Otherwise, AJ, appreciate your time. Folks, enjoy the rest of your weekend. Thanks for tuning in. We'll catch everybody next week.
Take care, everybody.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.